there's a retirement account that gets recommended to almost every solo entrepreneur, freelancer, and self-employed person the moment they start making real money. And on the surface, it looks like a great deal. Simple to open, high contribution limits, solid tax advantages. The SEP IRA feels like the obvious move. But here's what nobody tells you until it's too late. The structure that makes it feel simple is the exact same structure that quietly costs you tens of thousands of dollars, locks you out of some of the most powerful wealth-building strategies available, and leaves your heirs holding a tax bill you never saw coming. So in this video, we're going to go through 10 specific ways the SEP IRA fails solo entrepreneurs in real life. Not in theory, in real life, with real numbers. I've gone deep on this because most of the advice out there stops at, it's simple and the limits are high. We're going way past that today. By the end, you're going to understand exactly why financial advisors keep recommending something that, for most solo business owners, is almost always the wrong choice, and what you should be doing instead. Let's start with something that catches people completely off guard, usually right around tax season. When high earners want to move money into a Roth account but earn too much to contribute directly, they use something called a backdoor Roth conversion. You put money into a traditional IRA, then convert it to Roth. Clean, legal, and incredibly effective for building tax-free retirement wealth over time. The problem is that the IRS uses what's called the pro-rata rule to determine how much of that conversion is taxable. And the pro-rata rule looks at your total IRA balance across all traditional IRAs, including your SEP IRA. So here's what that looks like in practice. Say you've built up $93,000 in your SEP IRA over the years, and you try to do a $7,000 backdoor Roth conversion. Most people assume the $7,000 goes in tax-free. But the IRS sees $93,000 in your SEP plus that $7,000, and 93% of your conversion becomes fully taxable. You're not getting a clean Roth conversion. You're getting a mostly taxable one. And the moment you opened that SEP IRA, you quietly locked yourself out of one of the most powerful tax-free wealth strategies available to high earners. The fix exists. You can roll your SEP balance into a solo 401k before year-end to clear the pro-rata problem. But almost nobody mentions this at setup. People find out at tax filing time when the damage is already done. That's a serious hit on its own, but if you're over 50, the next one gets even more painful. The SEP IRA has no catch-up contributions. Zero. If you're 50 or older, a solo 401k lets you contribute an extra $8,000 per year on top of the standard limit. If you're between 60 and 63, that number jumps to $11,250. Think about who's most likely to be a solo entrepreneur at peak earning power. It's often someone in their 50s or early 60s. That's exactly when you want to be stuffing as much as possible into tax-deferred accounts, and the SEP IRA just doesn't let you do it. Run the numbers on a 60-year-old entrepreneur over 5 years, and you're looking at $56,250 in lost tax-deferred savings. That's not a rounding error. That's a real gap that compounds over the years leading up to retirement, right when you need the acceleration the most. And most financial advisors never bring this up when they're recommending the SEP. They hand you the simple option and move on. But here's where it gets interesting because the catch-up gap is really just a symptom of a deeper structural problem with how SEP IRA contributions work. A SEP IRA is funded entirely by employer contributions. There's no employee deferral component. That sounds like a minor technical detail, but it has a massive practical consequence when your income isn't perfectly consistent, which, for most solo entrepreneurs, is basically always. Here's a concrete example. Say you have a lower income year and bring in $50,000 in net self-employment earnings. Your SEP IRA contribution is capped at roughly 20% of your net income after the self-employment tax adjustment, so around $9,400. That's all you can put in. But with a solo 401k, you can make an employee deferral of up to $2,400 regardless of how much profit the business generated. That's a $15,100 difference in a single year, in a year where you probably needed the tax deduction the most. The 25% of income headline that SEP IRA marketing leads with sounds generous. But in a low-profit year, it becomes the worst-case scenario. The solo 401k gives you a floor that the SEP IRA simply doesn't have. And this connects directly to something that trips up a lot of entrepreneurs who thought they had flexibility built in. SEP IRA contributions are made the following April, based on the prior year's income. That sounds flexible, and it is, to a point. But here's the trap. If you projected strong income early in the year and mentally committed to a contribution amount, then your revenue dropped significantly mid-year because you lost a client or a project fell through. You're working backward from a number that no longer reflects reality. And if you've already been planning around that higher contribution, the adjustment is painful. Solo 401ks have some of the same timing issues, but the employee deferral component gives you a meaningful lever to pull. With a SEP, you're essentially just a percentage of whatever the business earned, with very little ability to optimize around income swings. The flexibility that gets advertised is mostly marketing language. In real life, variable income and a SEP IRA are a rough combination. Now, everything we've talked about so far matters. But the next 2 points are where high earners really start to feel the weight of this. You may have heard of the mega backdoor Roth. It's a strategy where you make after-tax contributions to a 401k and then convert them to Roth, either within the plan or by rolling them out. Done right, this can generate $30,000 to $40,000 or more in Roth contributions per year, far beyond what the standard backdoor Roth allows. For high earners who want to build serious tax-free wealth, this is one of the most powerful tools available. SEP IRAs cannot do this. There are no after-tax contributions, no in-plan Roth conversions, nothing. You're capped at the $7,000 to $8,000 range of annual Roth opportunity through the standard backdoor route. And as we already covered, even that gets complicated once you have a SEP balance in the mix. Over a 25-year career, the difference in tax-free Roth space we're talking about is somewhere between $750,000 and $1,000. That's not a footnote. That's a fundamentally different retirement outcome. And the thing is, most people who have a SEP IRA don't even know this strategy exists, let alone that their account structure is blocking them from it entirely. So now let's talk about what happens at the top end of the income scale, because the SEP IRA's limits aren't quite what the marketing suggests. For 2026, the SEP IRA contribution cap is $70,000. The solo 401k cap is $72,000. Those numbers look almost identical, and for most income levels, they are. But here's the difference that matters. The solo 401k reaches that ceiling through a combination of employee deferral and employer contribution. The SEP IRA gets there purely through employer contribution. That means, at higher income levels, the solo 401k actually hits the ceiling more efficiently, especially when you layer in the S-Corp strategy we'll get to in a minute. And for entrepreneurs earning well above $280,000, neither the SEP nor the solo 401k alone is necessarily the optimal answer. At that income level, a defined benefit plan or a combination strategy can shelter significantly more. But you can't build on top of a SEP the same way you can build on top of a solo 401k. The SEP is a ceiling. The solo 401k is a foundation. That's important, but if you don't also think about what happens to this money when you're gone, you're missing a piece of the picture that can hurt your family badly. CP IRAs are traditional IRAs, which means when you pass them on to heirs, those balances get pulled into your beneficiary's taxable income. If the money ends up in a trust, the compression is brutal. Trust tax brackets hit the top rate at very low income thresholds, meaning heirs can end up paying 46% to 49% on inherited IRA distributions. Even if your heirs are in a lower tax bracket than you, the structure of how inherited IRAs work under current law creates real compression risk. Solo 401ks offer more estate planning flexibility because of how they interact with rollover strategies and Roth conversion planning. You have more tools to manage the tax exposure before the money transfers. With a SEP, you've been saving for decades, and then the structure of the account itself becomes a tax problem for the people you were trying to take care of. Nobody thinks about this at account setup. It only becomes obvious in retrospect. Now here's one that I think surprises people more than almost anything else on this list. If you have a business cash flow emergency and your money is sitting in a SEP IRA, you cannot borrow from it. You can withdraw from it, but you'll owe income tax plus a 10% early withdrawal penalty. That's a painful and expensive option when you're already in a tough spot. A solo 401k, on the other hand, can be set up to allow participant loans. You can borrow up to $50,000 or 50% of your account balance, whichever is less, and pay yourself back with interest over up to 5 years. Think about what that means in practice. You've got $300,000 sitting in a SEP IRA, and an unexpected $40,000 business crisis hits. A lawsuit, a gap in receivables, equipment failure, whatever it is. You can't touch that money without getting hit hard. With a solo 401k, you loan yourself the money, you pay it back, and the interest goes back into your own retirement account. You're essentially your own bank for that transaction. For entrepreneurs who value liquidity and know that business surprises are real, this is a significant structural advantage that almost never gets mentioned when the SEP IRA is being recommended. And speaking of things that don't get mentioned, let's talk about the math behind actually calculating your SEP contribution, because this is where the simplicity story really falls apart. The SEP IRA gets sold as the easy option. Set it up in 10 minutes, contribute up to 25% of your income, done. But the actual calculation for sole proprietors is not 25% of your gross income. It's a reduced rate that accounts for the self-employment tax deduction, and the real effective rate ends up being closer to 20% of your net self-employment earnings after the SE tax adjustment. The IRS publishes a worksheet for this in Publication 560, and it's genuinely confusing. CPAs get it wrong. Entrepreneurs definitely get it wrong. Here's a real example. A solo entrepreneur with $150,000 in net self-employment income might assume they can contribute $3,750. That's 25% of $150,000, which sounds right. The actual number is closer to $27,875 once you run the proper calculation. If they contribute the higher amount, they've overcontributed, which triggers IRS penalties and often requires filing an amended return. The simple account just created a compliance problem. This happens more than you'd think, and it's a direct consequence of the gap between how the SEP IRA is marketed and how it actually works. Okay, so if you're still watching, and I hope you are, because this last one might be the biggest one for a lot of people, let's talk about the S-Corp strategy, because this is where the solo 401k completely separates itself. A lot of solo entrepreneurs eventually structure their business as an S-Corp to reduce self-employment taxes. The basic idea is that you pay yourself a reasonable W-2 salary and take the rest of your business income as distributions. Distributions aren't subject to the 15.3% self-employment tax, so you save real money. The strategy works well and it's widely used. Here's where the SEP IRA becomes a serious liability in this setup. SEP contributions for S-Corp owners are based on W-2 compensation. So if you're paying yourself a $60,000 salary and taking $190,000 in distributions, your SEP contribution is capped at 25% of that $60,000, which is $15,000. The distributions don't count. With a solo 401k, you get the employee deferral on top of the employer contribution. So on that same $60,000 W-2, you can put in $4,500 as an employee deferral plus roughly $15,000 as an employer contribution, for a total of around $3,950. And if you optimize the salary level and profit-sharing structure, you can push that even higher, well above $60,000 total in some scenarios. The SEP IRA in this setup isn't just slightly worse, it's missing the entire point of the S-Corp strategy. The solo 401k is specifically designed to work with it. The SEP IRA is not. So let's pull this all together because there's a clear picture here. The SEP IRA gets recommended constantly because it's genuinely easy to open and the marketing around it sounds great. High limits, simple setup, tax advantages. And for a business with employees, it actually does make sense. The structure works for that use case. But for solo entrepreneurs with no employees, it's almost always the wrong tool. It blocks your backdoor Roth strategy through the pro-Rata rule. It offers no catch-up contributions for people over 50. It ties your contribution entirely to profit, which hurts you in low-income years. It can't do mega backdoor Roth conversions. It creates estate planning complications for your heirs. It gives you no loan access in a cash flow emergency. The contribution calculation is genuinely complex and error-prone. And if you're running an S-corp, it completely misses the most powerful tax strategy available to you. The solo 401k solves every single one of those problems. It takes a little more setup, maybe an hour with the right provider. But that's a one-time friction cost against a lifetime of better outcomes. For most solo entrepreneurs, the difference isn't marginal. It's tens of thousands of dollars over the life of the account. And in some cases, it's the difference between having Roth flexibility in retirement and not having it at all. If you're currently sitting on a SEP IRA, and this video has you rethinking things, the good news is it's fixable. You can roll a SEP IRA into a solo 401k. That clears the pro rata problem, unlocks the loan feature, and opens up the Roth strategies we talked about. Talk to a CPA who actually specializes in self-employed tax strategy, not just a general practitioner, because the details matter here. And if this kind of thing is useful to you, the real math behind financial decisions that affect self-employed people specifically, there's a lot more of it on this channel. The next video worth watching is the one on solo 401k, setup mistakes, because there are a few ways people get that wrong too, and knowing them up front saves you the headache later. Link is right there. If you found this video genuinely useful, subscribe so you don't miss the next one, and drop a comment below. I want to know whether you're currently using a SEP IRA, a solo 401k, or still figuring out what makes sense for your situation. That feedback actually shapes what I cover next, so it's worth a few seconds. The SEP IRA feels like the simple path. But simple and optimal are not the same thing. Now you know the difference.